Today, we're going to talk about income riders. Now, if you're sitting here wondering what that is, it has to do with when you own an annuity, you can add what they call an income rider. So right now, you're probably saying, I have no idea what this is. And you just said the four-letter annuity word. So I don't want to listen anymore. But you are probably still listening if you've heard of this, if you've been tried to be sold one of these, or if you happen to own one. Undoubtedly, I come across in the last 2 weeks alone, I had 3 different people who I had not worked with before approach me and say, "Can you look at this? I'm getting, I have an annuity here, and I want you to give me an opinion on it. I'm getting 7% guaranteed on it, or I'm getting 8% guaranteed on it." And I immediately know that they have an income rider, and a lot of times they don't realize they have it either. Even though I haven't seen it yet, that's what's happening. I know they have an income rider. Tony, welcome to the show. Tony Shore's here. Tony, have you heard of these income riders before? Have you heard of this
Well,
feature of annuities?
I thought I saw a documentary on one of the streaming services, Income Riders. I just thought it was about a motorcycle gang, so I skipped right. I
Really
didn't.
wealthy motorcycle gang?
The Income Riders. Yeah, it's like these rich guys who go out on the weekends and are in this motorcycle gang called the Income Riders. No, of course I've heard of an income rider. It's something you can get on an insurance policy to pay you out monthly or quarterly or whatever once you're retired, right? That's what I understand it to be.
Yeah, and I've seen them, and unfortunately, a lot of times people are misusing them. They don't realize they have them, and they don't get them. They're sold improperly. But I want to talk about them, and just generally, I'm not going to talk about any one particular company, but I will say that you can get these on variable annuities and fixed indexed annuities. Those are the two where you can add these. And depending on what type of annuity it is, they might call it something different. So you might hear guaranteed lifetime income rider, lifetime income benefit rider, LIBR, a guaranteed minimum withdrawal benefit, a guaranteed minimum income benefit, a guaranteed lifetime withdrawal benefit. So there's all these different names and acronyms, but they all mean one thing. You're getting some sort of guaranteed lifetime income, whether on yourself and your spouse, in as part of an annuity. And it's an extra feature, meaning by default, these annuities don't necessarily come with some sort of income feature. You add a rider. That's what the term rider is referring to.
Well, guaranteed lifetime income, those 3 words, Dan, sound fantastic to me. I mean, people
Right.
hear that, and I mean, those 3 words together, wow, who doesn't want a guaranteed lifetime income? Who wouldn't want that?
Right. It's, you could call it Social Security, a guaranteed lifetime
Yeah,
income.
right.
So, yeah, a lot of people buy these annuities. There's 2 main reasons to buy an annuity. And the primary reason that's historically been the case is you buy it for income. You buy an annuity, give you income. And the problem with that is, especially in the 80s, when people were buying these things, they'd give the insurance company money and then they'd get money back for their life. And when they died, nothing was left for their beneficiaries.
Right.
And people didn't like that. They didn't like that feeling, even though they were getting their income and they would keep getting it if they lived to 120. They didn't like the idea that there was nothing there. So what the insurance companies did on variable annuities and indexed annuities, they added income riders, which allow you to get a lifetime income. And in many cases, there's a death benefit if you don't use up all your income. You don't use it all. You die early, you got some sort of death benefit. So the purpose, though, is right. It's to provide a guaranteed lifetime income stream. Usually in the future, you could buy these and get it right away. But most of the time, people buy these things. They put their money in an annuity, and then they say, in 5 years or in the future, I'm going to start taking income from it. Regardless of what happens to my principal, there's going to be some sort of income stream.
Okay.
That's the main purpose of these things.
But people don't, the
Problem is
problem
they-
comes that people don't understand the costs or the setup. I mean, they can be made to sound great. You're going to make this interest, this is guaranteed, but they don't understand the costs, or am I really making that in? How much am I making after the fact, right?
Right. And so that's the big thing, is the big misunderstanding that I run into when people get one of these or have one is they'll say to me, I'm making 7% guaranteed. And I'm saying to myself, no, you're not. They're not. Now, we're getting closer to where annuities are paying a fixed rate of 7%. We're close. We're at, you can get 6% right now. This is the end of 2023. But the income riders are a separate thing that isn't interest. You're not getting a guaranteed interest rate.
Right.
You're getting what they call a guaranteed increase in your income account value. So when you buy one of these things, or if you own one, you got to remember it's split up. It's bifurcated into two separate pools of money. You got your account value, which is what your principal is. Say you give $100,000 to an insurance company, that goes in your account value. And if it's in a variable annuity, it could go up and down. If it's in an indexed annuity, it's either going to go up or sideways, right? So, but that's your principal, right? And that's your account value. That is not the income value. The income value is a separate account. I call it a phantom account, but it's a separate account, separate number, and they call it the income account value, also known as the benefit base or the income base. And so you have to remember there's two different pools of money. You got your money that you put in, that's your account value, that's your walk away value, that's your death benefit. Then you have this income account value. And the only purpose of that is to determine how much income you're going to get. There's no death benefit there. There's no, oh, look at that, I'm getting 7% growth guaranteed. Yeah, on your income, but you're never going to get that as a death benefit. It's never, you can't pull it out. It's just a calculation. And that's what gets people confused. It's like, oh, it's just a calculator. It's just a random number. It's not random. It's got some sort of fixed rate growing, but yeah, it's just a calculation. It's just this accounting vehicle, and it has nothing to do with your account, your value, your death benefit, your walkaway, your principal. It grows separately. So when you get your statement, you'll see here's your contract value, and then over here, here's your income value, and you'll see that too. And usually, the income value is going to be a lot higher because you got some sort of guarantee, right? That's where people really get messed up. So when someone says I'm getting 8% guaranteed, I immediately know they have an income account value that's growing at 8%. They think that they're able to take that and walk away after 5-10 years, which they cannot. Because, Tony, the only way to get that high income account value is through a lifetime income stream. You can't get it as a lump sum. And that's the rub. So yeah, you might have this contract that says, no matter what the market does, I'm getting an 8% guaranteed on my income account value. That's all well and good. But how do you actually get that 8% back through a lifetime income stream?
Good question.
You can't walk away with it. Or if you die, that lifetime income, that value doesn't go to your kids. No.
I thought you could get an annuity now with a lifetime income rider where it would go to your spouse or children, or what's left in the account goes to them.
What's left in your account value goes to your beneficiaries on these income riders. But the income rider account that keeps growing and growing, that number doesn't go to your beneficiaries. You can get a separate rider called a death benefit rider that has a account that goes up and is only available as a death benefit. But for income riders, that's only available for income.
Why are you the first financial advisor of the hundreds I've talked with and worked with over the years that has actually said that has actually explained that? I think that's conveniently left out of the discussion.
It's required to be explained, or else it's illegal, right? You have to explain this to clients. And so, but it's a lot easier to just say, hey, you're getting 8% guaranteed, because that's what they hear. And they're like, oh my God, why wouldn't I sell my house and buy this, right?
But I mean, on the TV and radio, on the TV and
right.
radio, I'm not hearing that. I mean,
No.
sure, I think they're explaining it when they sit down with them, but yeah.
It'll be something like, you can get an 8% guaranteed on an income account value. You know how they do that. 7.5% guaranteed for the next 10 years, guaranteed. An income account value only payable during the next for the rest of your life. Right? That's the fine print.
You can't pull it. You can't pull that money out before the end of your life.
Right. So, but when you do finally say, okay, so what happens is people put their money in, they put 100,000 in, and the income account value grows to 200,000 over the next 10 years. Hooray. But what's happened to their principal, the 100,000? Well, you mentioned it in the beginning, people don't realize a fee. Usually these income riders have a fee of usually around 1%. So if nothing, their account's going to go down by 1% a year because there's a fee associated with this rider, the extra feature. Then their principal might go down if the market goes down and they're in a variable annuity. The principal might go up if the market goes up, or if they're in an indexed annuity and the market goes up, they might get some, but always that fee, right? So their account value is not going to grow guaranteed. It's going to, it's going to go like this. But their income account value is what they paid the rider for. And so that is going to, once they turn the income on, say, all right, now you're going to get 1,000 a month for the rest of your life, that comes off their account value. So now their 100,000 is going to be 99, and then the next month 98, because they're taking money out. Eventually, their value will go to zero. Well, why would I want that? Because the insurance company is on the hook to pay you that income. That's what you're paying for. So really, the bottom line with these income riders, they're longevity insurance. And the only reason why you buy them is to protect against outliving your money. I'll give you an example, Tony, because this might help to people listening saying, oh, I still don't get it, because it is kind of confusing. Let's say you bought an income rider on an annuity and it grows at 7%. And the payout is going to be based on what they call a payout factor. What's a payout factor? It's going to be how old you are, what your gender is for some companies, and whether or not it's a single life or joint life. If it's going to be a lifetime income for you and your spouse, it's going to be lower income because they got to cover 2 lives. If it's just for you, they'll give you more every month if you want. And then, of course, there's a fee of 1%. Now, let's say a 60-year-old buys one of these for 100,000 with a 7% guaranteed. 5 years later, we know what their income account value is going to be. We just know it because it's getting 7%. It's going to be 140, around there, right? I'm using round figures. So what's their account going to be worth? I put 100,000 in at age 60. What's my annuity going to be worth at 65? Well, I don't know. What kind of annuity is it? Is it a variable? Then we have no idea of knowing what it's going to be. It could be up, it could be down. Is it it's a fixed indexed annuity. Well, we know that it's going to be either flat minus the fee. So it's going to be either down 1% a year. So it's going to be down 5%. Or it could be higher, but it's not going to be 7%. Maybe, probably not. So the income account value is designed to be higher than the actual account value. And the account value is unknown. Okay, so fast forward, now we're 65, and I want that 140. How can I get it? You can only get it as an income stream. Turns out, payout factor for single life for this particular company at age 65 is 5.5%. So you get $7,700 a year, 5.5% of the 140. That's how this works. So it's all based on your age, when you buy it, what's it worth, and then they do a calculation. At 65, they say, we've calculated based on your income account value. Your income rider says you're getting $7,700 per year for the rest of your life. Well, I don't want that. That's going to take me 20 years to get my money back. Well, can I recalculate that? No. Can I get my money back? No. Well, what? I don't even want income. Why'd you buy an income rider? That's a very common thing I get. Why do you have this income rider? I don't know. I wanted 8% guaranteed. Or are you going to take it as an income stream? No, I'm just going to leave it to the kids.
Yeah. So, but the key is, I think, Dan, you're not saying no one should get a fixed index annuity with an income rider, right? Because it is advantageous if you want guaranteed income in retirement. I think we have to look at the reality of it is and say, oh, I'm not getting that growth on my actual money. I can't take it out and use it whenever I want. It's for an income rider for the rest of my life. But that's what a lot of people want. That way, it's just one more thing will be there to pay the bills each month, along with Social Security, which is very helpful. It's like a pension. It's like Social Security. And so that's a good thing in a way. However, if they take that money instead and put it in the market or an IRA, they're not guaranteed any amount of growth. And if the market could go down and then they do need that money to live on, they could deplete that much faster and then run out of money before they, right? I mean, isn't that the advantage?
Everything you said is correct. So the key is they're not for everybody, but they're not terrible. You can use them for a very specific person. And the only person that should be buying an income rider is one that wants lifetime income. You're not going to buy an income rider just because now some of the companies offer it free, like a free income rider if you ever want to turn on income. That's not what we're talking about. I'm saying you're usually better off getting some other type of product or investment if you're not planning to turn it on to income. Why are you using an income rider?
Right.
Why?
Right.
And when I ask that question, people start to say, yeah, well, because I thought I was going to get 8% guaranteed. Well, that was wrong.
You don't do income riders for the growth. It's not a growth return vehicle for the return or the growth. You do it for the
growth of income, future income only. That's why you own
lifetime income. Yeah.
Right. So if you're sitting there saying, well, I thought this was a good idea. I kind of want the pension, but my company doesn't offer it. So you could take a portion of your 401k, put it into an income rider product, and have a future income stream that you plan with Social Security, and there you go. So there is a valid purpose for them. But, way too often I see people have these for no apparent reason. It's just and
they don't know. Yeah, right. They thought they were going to make. Hey, if I can make 7%, or 8%, that's better than the CD. So let's put our money in. But
exactly. That's poor. That's poor. I guess would be fiduciary responsibility was not met in that case. It was a sale. It was a salesman as opposed to a financial planner.
Yeah.
Right. If you don't, right. Some things to watch out for if you're thinking about these, which I'm not saying they're bad, but if you're thinking about it, watch the fee. What is the fee? Know that there's a fee, and that comes off of your account. Do you have to annuitize in order to get that rider? Some companies say, we're going to give you a higher amount, but the only way to get that is that you have to give up control of the asset. That's called annuitization. Some companies require that. When can you begin? Do you have to wait 10 years before you can turn on the income? I've seen this a lot. I've got an income rider. I want to turn it on. But the company says I still have another 5 years. What? Yeah. There are some income riders that say, we're going to give you this higher amount, but only if you wait 10 years. Well, you should have told me that before I bought it, because I needed the money before 10 years, right? You got to know, is this a single life or joint life? I've run into people that think, oh, if I die, my wife's going to get the rest. It's going to continue this income. Oh, no, you got a single life payout. You can't change that now. It's too late. What? Each company's got their own unique differences. You got to know this stuff. It's not to be toyed with. Is there a cost of living increase? Some of them have a cost of living increase. Usually, if you get a cost of living increase income rider, they're going to start you out much lower. And so you got to do the math, But those are some things to watch out for. They are mostly, I call them a bell and a whistle on an annuity. And the only reason you should have them is if you really need that income. If you don't need the income, why are you getting it?
But you've worked with people where it makes sense. And really, when it comes to retirement planning, isn't the key hurdle most people have, and the key reason you have your job is to create income, solving for income in retirement. You're taking your lump sum savings from 401ks and IRAs, and you've got to create an income that is going to be there each and every month, which is the whole reason the fixed index annuity with these income riders was created, correct?
Exactly. So these are very useful on either a variable or an indexed annuity if you have an income need. And that's one of the goals I have with people when they meet with me is, all right, what is your income need? And let's solve for it.
Sure.
A lot of times you don't need to buy anything crazy like an income rider to
Right.
do it. And I say crazy, it's complex. You could just create the income off of dividends. You can create the income off of withdrawals, just basic interest. But sometimes it's like, I don't know, I need to have an income at this point. And then at this point, I like the idea of a pension, turning these on. Well, this is what you're doing. You're creating a pension stream using an income rider, and that's perfectly legit. You just, my caution is you just got to know what you're doing. And they go by many names, but the purpose is the same. Make sure you're buying an income rider or a guaranteed minimum withdrawal benefit or a GMIB. Make sure you're buying that because you want lifetime income, and make sure that the lifetime income matches with your timing and your situation. Just don't fall victim to, oh, that sounds great. 8% guaranteed for life. Wow, that sounds like I can't lose. Well, it's not all it's cracked up to be if you don't understand it.
Sure. It's not all sunshine and smiles, right?
No, it's not.
Right. Well, but hey, really quick before we go, I know you're trying to wrap up. I have one question about this that's bugging me. So the income riders, you've explained that they're not for everybody. Is there then a use for, what about a fixed index annuity without an income rider? Is that a thing? Or do most fixed index annuities have income riders?
No, they don't. So the income riders are an added feature from most index annuities and variable annuities. It's an added feature which comes with a fee. Some of them have it built in, but when you're looking at like an index annuity, you're saying, what is the purpose of that? If it's not income, which is usually the purpose of an annuity, then it's for safety of growth. And that's when you have to start comparing it to some other options, such as a fixed annuity with a set guaranteed interest rate, like a MIGA, or a CD portfolio,
CDs and MIGAs.
Bond ladder. Like a bond ladder would be a comparable alternative to an index annuity. But if you're looking at like a variable annuity without an income rider, you're going to want to compare the variable annuity to a stock bond portfolio mutual fund, right? So you have to, you can't compare these two to each other, variable versus fixed. You can, but
and I realize that's another discussion. We've talked about annuities on other shows.
Right. But you can have an annuity without an income rider.
Right.
That's probably not going to be for an income purpose. That's going to be for a safety, growth, future use, a place to hide it for now, tax deferral, something like that. But
Okay.
All right, Tony. So don't, if you're out there listening and you're still listening, don't fall victim to coming to me and saying, I got this income rider. I have no idea what it means. Don't come to me and say, I'm getting 8% guaranteed on my principal. You have an income rider. You just don't know it. Thanks for a good show. We'll catch everyone next week.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.